Hello and welcome to our latest urgent market update video brought to you by the Live Trade Room. Now today is Thursday the 9th of March and the title of this short video is Further Downside Market Moves Expected. It's just a case of when. So what we're going to do is we're going to have a look at a few aspects of these financial markets which are very much bearish in context. So what that's likely to do is to give us some very significant opportunities. We've already been able to get into these trades over the last 3 weeks in a series of really profitable trades, and we just anticipate that there is more to come for these reasons. So we'll break them down for you as best we can very shortly. If we could start, of course, with our risk warning. Just take a brief moment to familiarize yourself with our risk warning currently up on screen. And let's get into the meat and bones of this topic. So the first place to start is to just have a quick review of some of the news events over the course of the week. So on Tuesday, we had some very important news events. Not only are central banks still in this rate hiking cycle, you can see the RBA, increasing their interest rate by 25 basis points. We also had a very important news event at 3 p.m. on Tuesday, which was really Jerome Powell testifying in Washington. So this is where the central banker gets in front of the politicians and over a course of 2 days, he is grilled pretty significantly. And as a result, the markets kind of respond and react accordingly. So off the back of this event, I will show you exactly what we saw as far as, let's just take the indices, for example. You could also take markets like the euro dollar. This is what we saw as a result. So the markets reacted in an incredibly bearish response. And this is the dollar strengthening quite considerably. If we look at the US indices, we saw this very significant response on Tuesday, should I say, just gone. So really, the market reacted in a very, very bearish capacity, and it's really because the net result was that the Fed are needing to be a lot more hawkish than perhaps was initially expected. So we don't necessarily think that the volatility we saw on Tuesday is representative of the repricing that would be needed. So again, on this level, from a technical perspective, we'd expect further downside in this market. So do keep an eye out for that. Not only do we have a very technical bearish outlook of these markets, we also have on a fundamental perspective. So it's probably a good place to start with the bond markets. So not only are the Fed in this situation where they need to perhaps increase the rate size, I'll discuss it in just a second, but the Fed over the last couple of meetings have just slowed down their rate hiking expectations from 75 basis points down to 50, down to 25. Now it looks like they're going to need to start to speed up again. And again, it's this repricing that we're going to be very interested in. In addition, currently up on screen, you'll see the differential. This is inverted yield markets, if you're hearing an awful lot about that. This is what this implies, that the interest rate on the 10-year Treasury yield is 3.98, and on the 2-year, which is the near term, you got 5.03. So you can see that the yield on the 2-year is significantly higher than that over the longer term, the 10-year period. And again, this is another very, very bearish element to these markets. And you can see the very significant upside. And when these bond yields push higher in this fashion, we would certainly be looking for further downside pressure on these markets. And just regarding the inversion, these are inverted markets. So there is, as you can see currently up on screen, we have 105 basis points differential between the 2-year and the 10-year. And that has been widening more and more over the last 12 months. It's going to be difficult to know where this this inverted market conditions actually going to peak. But for now, certainly it's applying further downside pressure. In addition to that, let's bring up our Forex calendar, and we're going to just skip ahead very, very quickly because I want to show you just the slowing of these interest rates over the last couple of periods, and what we're likely to see next. So if we go to the federal funds rate and we just get up the chart here, we've got the next meeting on the 22nd of March, so worth pointing out. So just to, again, this is always the higher rates go, the more pressure it puts, the increase the cost base becomes for corporates. The cost of refinancing and debt starts to increase significantly, and that has a negative impact on the balance sheet. Plus, the higher rates go, I suppose the negative impact that's likely to have on demand and economic output is all a bit of a weight for these financial markets. So if we just go back to June of 2022, we all know that these financial markets took a really strong rollover to the downside, despite the Fed looking to raise rates. So we saw a 75 basis point rate hike in June, another 75 in July, September, another 75. And then in November of last year, we saw another 75 basis point rate hike. So we saw 4 back-to-back 75 basis point rate hikes, and that was seen as a really significant event. And then there was, I suppose, some positivity and signs that inflation's coming down a little bit. So they started to take the foot off the pedal. In December, they reduced the rate hike to 50 basis points. And to conclude, in February, on the 1st of February, we saw the Fed actually reduce rates just by 25 basis point rate hikes. The problem we've got is in that meeting, Jerome Powell, the Fed chair, actually made lots of references to how much deflation is in the economy. And since that point, we have seen inflation remain very sticky, if not increasing in areas. We've seen unemployment remain remarkably strong. We've also seen resilience, and we've seen the economy performing relatively well despite this kind of context and backdrop. So I suppose the central bank falsely gave a bit of hope that we are nearing the top, that we're probably going to start rolling over. We probably won't get too much above 5%, and now that's been thrown away to some degree. And now we're expecting these rates to get up to 5.6, 5.7. For us, probably maybe even up to 6%. We've been saying that now for quite some time. So the Fed themselves are kind of struggling with credibility. And again, that's all probably bad news effectively for these markets. So really, what is our response? And to be fair, our response is the same, and it has been now for a little while, is this narrative currently up on the screen. And this is the narrative that we're really focusing our attentions on. And it's this higher rate type environment for longer, and it has a risk-off impact on these markets. So I've discussed, the situation behind the fact that the Fed need to increase rates and probably speed up the rate increase now again, because they do seem to be really behind the curve. We've got this sticky, if not higher, inflation beginning to creep back in. So we can look for risk-off market conditions. This is the purpose of this particular video, is to identify, what direction are these markets likely to move. For us, they are very much in a further risk-off market condition, and we expect further downside across the equity markets. The indices to make those moves lower, the dollar to strengthen, bond yields to continue pushing higher for now until something changes, and the commodities lower as well. And we're really sticking with that kind of narrative. Let me pull this off the screen. We're really sticking with that narrative as things develop. Now, to translate that into where do we expect these markets to go from here, we're still incredibly bearish these markets, and we do anticipate further downside. Below 4,000 in the S&P 500. We're currently below that as we speak. We expect further moves to the downside, maybe 39, 3,800, potentially. NASDAQ further to the downside. We're currently getting a little bit of a bounce, as you can see, in the dollar pairs over the last couple of days. What was interesting from Jerome Powell is that his comments were very hawkish on Tuesday, and then they were kind of reversing that sentiment a little bit on Wednesday when he was grilled on Wednesday. So again, a mixed bag for these markets, which is really why there's a little bit of hesitation over the last couple of trading days. But when this little bullish move expires, we do expect a series of very profitable selling opportunities begin to creep into these markets. So we're in the process of just waiting for these markets to roll back over. We're already making a little bit of joy on the US indices side. And again, from US oil, we'd expect commodities to continue to roll over to the downside, gold to roll over to the downside as well, and the dollar to strengthen across the board. So that's against the euro, against the Aussie, and against the New Zealand dollar. We expect further downside. Once this little short-term, little bullish market condition plays out, they'll start running for the exits. It creates more volatility to the downside, and we are anticipating a further move lower. So let's see whether this all, these are some of the trades that we've been focusing on for the last few weeks and performing really, really well. And we just anticipate that this narrative is likely to continue for longer. So do bear all of this in mind, that we are strongly focused on this narrative for now. And all those commentators that are talking about the Fed needing to pivot, this idea of sort of kind of a dovish market condition, that the Fed don't really mean what they say, they're not going to actually increase rates. We think they will end up delivering on that, and that would just be bad news for equity markets, and this risk-off trade is likely to play itself through. So on that note, guys, that just about concludes this short video. So we do expect further downside market moves for all the reasons that we've discussed. There's probably, if we didn't even really go into the really strong employment numbers we're likely to anticipate on this Friday. And the next week, we've got potentially quite sticky inflation coming through as well. So we've got a lot of news events in the pipeline that are very likely to have a very significant impact on this downside expectation. So keep your eyes open for that. And we will be producing a couple of videos next week now along those type of lines. So that just about concludes this urgent market update video. If you do have any questions, do feel free to email us at support@thelivetraderoom.com, and we'll get back to you as soon as we possibly can. So look, thanks very much for joining us. Do stay tuned for our next video. And just to let you know, we do broadcast live every day from 7:30 a.m. every single morning. And that allows us to put our trade plan together to discuss market fundamentals, sentiment, and technical opportunities. And then we actively trade live from 8 a.m. every single morning, and again at 12:45 UK time for the US trading session, 8 a.m. for the European. And we are, like I said, trading live every single day, Monday to Friday. So if you would like to join us, you're very welcome to do so. For more information, just go to thelivetraderoom.com, and feel free to contact us through the chat function as well if you have any further questions. So from everyone here at the Live Trade Room, thanks for joining us for this short video, and we'll speak to you soon. Bye for now.